Hello and welcome to session 10 of our Series 7 exam overviews, once again brought to you by Passing Score, where you can find additional material like apps and practice tests at PassingScoreFinance.com. In this video, we'll be going over savings accounts. This starts with things like the IRAs, but also other types of savings plans that have certain tax benefits. Let's start with the individual retirement account though. It must be funded by working income. There's an annual limit of $5,500 for 2013, and this can change every year though. It's 100% or 100% of the compensation if it's less than that. If you're 50 and older, you can contribute an extra $1,000 every year into your IRA account, and this is meant for people to catch up towards their retirement goals. The deadline is for contributions is April 15th of the following year, so up to that point in 2014, you can still contribute towards your 2013 tax filing year. Any contributions above the limit are penalized at 6%, so you probably don't want to do that. Spousal IRAs have the same limits as other IRAs, so you just combine the individual limit amounts. Most investments are allowed into IRAs, but certain exotic things like art or antiques or even insurance policies are not allowed. In addition, banks can have more restrictions as well as to what kinds of investments they want to handle in their IRA accounts. Banks act as the custodians of the accounts, but the clients are the ones who decide how much and what kind of investments they're going to have. IRA withdrawals are penalized if you're under 59 and a half years old at 10%, with the following exceptions: death, certain medical expenses, and other types of exceptions. Mandatory withdrawals must be made after you turn the April 1st after you turn 70 years old. These are RMDs, or required minimum distributions. They're calculated based on your life expectancy, and you pretty much want to comply because the penalty is subject to 50%, so pretty substantial. Roth IRAs are made with after-tax amounts, so they're not subject to the required minimum distributions. A Roth IRA gets the benefit not from deferring the tax when you contribute into the account, but when you actually make the withdrawal from the account. So all the capital gains, interest that you have in the account over the years don't end up being taxed by the time you end up retiring. The limits for contributions into both kinds of IRAs are the following. They begin at the lower amount and begin to phase out until you can't make any kind of contribution, starting at $127,000 and $188,000 of AGI, or adjusted gross income. Other types of retirement accounts are covered under ERISA, or the Employee Retirement Income Security Act. This sets up the rules for certain private qualified retirement accounts, and they require funding and non-discrimination rules. Basically, all pensions must comply with ERISA, and it also establishes other types of accounts like the 401k, which you've probably heard of. The requirements are listed here in general. The most important things are the plan must be in writing, and the fiduciary has to act under the prudent man standard. The fiduciary is the person running the plan, not necessarily making the investments, although that does happen in some cases, but running the rules and who will qualify in the vesting of the investment plan. A prudent man standard is what a reasonably trained and educated person in investments would do under similar circumstances. The main benefit is that employee contributions and employer contributions and gains are tax deferred in the plans until they're actually withdrawn at retirement. Here are some of the types of plans: the 401k, the ESOP, profit sharing. There are some plans specifically for self-employed or very small employers, such as Keogh and SEPs. And then there's other types of plans, and we'll see these in a minute, like the 457 and the 403B. The 401k is a pre-tax employee contribution with a max of up to $17,500. That's the most that the employee can contribute into the account. If you're over 50, you can give an additional $5,500. On top of that, the employer can contribute towards your 401k as well. But the combination between the two has to be less than $51,000 for 2013. And again, that tends to rise over time. Employer contributions, what the company puts into the account, they're allowed to put certain vesting rules on their amounts before the employee can have access to their funds. The profit sharing plans are basically what it says, contributions of profits made by the company every year. They can't exceed 20% of the compensation of the employee, and the profit and contribution must be substantial and recurring. So remember, there's a 25% max of the covered compensation for profit sharing plans. ESOPs, or employee stock ownership plans, are, again, like it describes, contributions of stock into an employee's retirement plan. These contributions are made at the discretion of the employer. They're priced at the market value for tax deduction purposes, and they're meant to align the interests of the company along with its employees. The risk is that the employee becomes over-concentrated and has undue risk in just one company. A Keogh plan is one of these plans for small or individual self-employed owners. They have the same limits as 401k plans, but they do have a 20% pre-tax income limit of what can be contributed. And contributions in this case are deducted on an individual tax return, since we're talking about self-employed people. A simplified employee pension is again for small businesses or self-employed individuals. Contributions are 100% vested. Each employee gets their own separate SEP IRA account, and again the same limits as the 401k, with a max of 25% of the employee's salary. In addition, there's three restrictions. The employee has to be over 21 years old. They have to have spent 3 of the 5 last years at the company, and they have to have earned more than $550 to qualify for a SEP, or Simplified Employee Pension. A 403b plan is targeted towards nonprofits or tax-exempt types of organizations as defined contribution plans. This includes churches and school retirement plans, which can be qualified or tax-deferred annuities. Otherwise, it's similar to 401k in the employee and employer contributions. A 457 plan is mainly towards governments, but some nonprofits. Again, we see the same limits as the 401k, but it must be kept separate from a 401k account. They can't mix the funds even when they roll over the accounts once they've left the organization. There's no early withdrawal penalty for these types of plans, which makes it different from 401ks. Non-government plans are limited to higher compensated employees, so not for the general employees of the non-profit, non-government plan. Now we start into some education savings accounts, beginning with the Coverdell. It's a tax advantage education savings account. So it's meant to save for certain qualified education expenses such as tuition, books, and materials all the way through university. Contributions can continue to be made into the account until the student or beneficiary turns 18 years old, unless there are some types of special needs involved, in which case there's no limit. Withdrawals can be made from the account until the beneficiary or student turn 30 years old. If there are still funds left after that point, the account can be transferred to someone younger that still has these types of qualified expenses. And there's a 10% penalty for non-qualified uses of Coverdell funds. The other education savings plan is a Section 529. This is basically prepaying your tuition. Since tuition prices have been increasing so quickly, it's a way to turn those increases into gains. So they're typically administered by states or university, and grows at the same rate as the tuition. Other types of expenses can be tuition, books, or supplies covered under a Section 529 plan. That's it for our savings account section. If you have any questions, please feel free to email me at john@passingscorefinance.com. Otherwise, good luck on your exam.